Okay, let's unpack this. Have you ever looked at a company you know so well? A name that's basically synonymous with childhood, with imagination, and wondered, is this also a smart place to put your hard-earned money? Can the magic of Mickey actually translate into real financial growth?
Well, what's truly fascinating here is that almost everyone has a strong opinion on Disney as a brand, right? As a cultural force.
Right.
But honestly, very few people ever really dig into the fundamental economics, what makes it tick as a business. And today, well, we're going to do just that.
Exactly. We're taking a deep dive into the Walt Disney Company. We're going to try and lay out the full picture for you, the good, the bad, the truly fascinating bits. Like we're just sitting here talking it through, figuring out if this iconic business is, a compelling investment opportunity right now, or if maybe the challenges just outweigh the potential.
Mm-hmm. We'll explore its core strengths, definitely, but also the significant challenges it faces in, well, a rapidly changing world. And we'll look at what the financial numbers truly reveal about its underlying health. Our goal is to help you understand not just what Disney is, but crucially, why its future matters, not just to its fans, obviously, but for anyone interested in, enduring businesses and the sheer power of intellectual property.
Yeah. So if you find this kind of in-depth discussion helpful, maybe it sparks a new thought or clarifies something for you, please do hit that like button. It genuinely helps us out. And if you want more deep dives like this one delivered straight to you, maybe consider subscribing. That way you won't miss our next big topic. All right, let's kick things off by talking about the real machinery behind all that Disney magic, how this colossal company actually makes its money. Because it's so much more than just, blockbuster movies and those enchanting theme parks. What we've really come to understand is that it's a global entertainment ecosystem.
That's the key word, ecosystem. You can really think of it as a self-reinforcing flywheel. The genius here, I think, is that the company creates these amazing stories, these characters, this incredible intellectual property or IP, and then it provides just a multitude of ways for us, the consumers, to experience and interact with them.
It's like a multi-pronged approach to creating value, and it sort of compounds over time. Let's maybe dissect this by their core segments, starting with what they call entertainment.
Mm-hmm.
This segment is really the genesis, the absolute starting point for all that incredible IP we just mentioned. It's where the stories actually begin. This includes their major film studios. We're talking Walt Disney Pictures, Pixar, obviously, the whole Marvel universe, Lucasfilm. Plus, it covers all their TV production, too, creating content for, traditional networks, but also increasingly their streaming platforms.
Okay, so how does this segment actually bring in the cash?
Right. Primarily, it's theatrical box office, movie tickets, licensing that content out to other distributors internationally, too. And critically for their future strategy, their direct-to-consumer or DTC streaming services, so Disney Plus, Hulu. These platforms generate revenue from, your monthly subscription fees, but also a rapidly growing advertising business.
Okay.
And just for context, for their fiscal year 2024, this entertainment segment pulled in a hefty $41.2 billion in revenue. It's like the engine that sparks the whole creative process, really laying the groundwork for everything else.
And that creative engine, it truly feeds into everything else, doesn't it?
Yeah.
So looking at the next segment, sports, this is, overwhelmingly dominated by ESPN, that iconic brand.
Huge brand.
Historically, ESPN has just been an absolute powerhouse of cash generation for Disney, raking in these really high margin affiliate fees from cable and satellite providers. They pay a premium to carry those channels. Plus, on top of that, there's a significant advertising revenue stream, especially from live sports.
Yeah, live sports are king for ads.
Exactly. Now, just like the broader media world, ESPN is right in the middle of a massive transition. It's actively moving towards a DTC model itself, trying to capture audiences who are, cutting the cord, moving away from the traditional cable bundle. This means building out ESPN Plus as a standalone streaming service and looking ahead, launching a full-fledged direct-to-consumer ESPN offering.
That's a big shift.
It is. In fiscal year 2024, the sports segment generated $17.6 billion in revenue. Still a powerful brand, definitely, but it's clearly having to adapt to these profound shifts in how people actually watch live sports now.
Okay, then you have what I genuinely think of as the ultimate monetization engine, the crown jewel maybe, the experiences segment.
Ah, yes, parks and more.
Exactly. This is where all that fantastic IP really comes alive in the physical world. where that emotional connection you have with the brand deepens into, tangible memories. We're talking about the world-famous theme parks, resorts like Walt Disney World, Disneyland, the Disney Cruise Line, which is expanding, and their huge consumer products and licensing division. So everything from action figures to princess dresses.
Right. So how do they monetize here? It seems like a lot of different streams.
It is. Park admissions, obviously, hotel stays, food and beverage sales, which are huge, merchandise, of course, and royalties from licensing their IP for physical goods sold all over the world. And here's the really crucial insight, the one that I think often gets overlooked in the sort of day-to-day chatter about Disney. This segment is, by a significant margin, their most profitable. It's their true cash cow.
Okay, lay some numbers on us.
Right. Let me throw out some numbers from fiscal year 2024 just to really drive this home. The experiences segment generated $34.151 billion in revenue. That's about, 38% of their total top line. But here's the kicker, the real eye-opener. It contributed a staggering 59.4%, almost 60% of their total operating income.
Wow.
Yeah, bringing in $9.272 billion with an impressive 27.2% operating margin. Now compare that to entertainment. Higher revenue, right? $41.2 billion. But it only made up 25.1% of operating income with a much lower 9.5% margin.
Big difference.
Huge difference. And sports, while profitable, still only contributed 15.4% of operating income with a 13.7% margin. I mean, those differences aren't just small tweaks. They are profound. They really show where the company's true economic power lies.
Okay, so if we connect this to the bigger picture, that data reveals a crucial reality that often gets lost in the headlines, I think. While the market often focuses intensely on the competitive and historically, let's face it, lower margin streaming business, which sits within entertainment, the true economic engine, the cash-generating heart is the high-margin experiences segment. Disney isn't just a media company that happens to own some parks. That's not the right frame. It's really a high-return consumer experiences company fueled by world-class content. It's a really important distinction when you're thinking about the long-term economics, the investment thesis for this business. This segment transforms that intangible IP into tangible premium experiences that command significant pricing power and generate enormous cash flow.
And what's truly remarkable about this whole structure, this flywheel effect you mentioned, is its simplicity and its endurance. The underlying logic is pretty straightforward, and it feels durable, right? It's built on these timeless human desires for storytelling, for escapism, for community, shared family experiences.
Absolutely.
For a century now, Disney has been creating characters and worlds that forge these really deep emotional connections with audiences. And then they monetize those connections through immersive engagement. Think about like a new Pixar film. It's not just a movie, right? It's the genesis of maybe a new theme park land, a line of toys that sells out everywhere, a new character meet and greet on a Disney cruise ship. And all of that then feeds back into funding the next big idea.
That's the flywheel in action, turning imagination into, hard currency.
Exactly. And while the methods of distribution will certainly evolve, I mean, we've seen the shift from theaters to streaming, broadcast TV to on-demand apps, the core asset. That amazing IP, it remains constant and valuable. It's kind of the definition of adaptability, isn't it? This fundamental concept has been working for 100 years, and it still feels profoundly sound today. So any smart investor wants to know, what truly protects this business from competitors? What's its fortress, its economic moat? When you talk about Disney, their primary moat is, overwhelmingly their intangible assets.
Or IP.
Yeah. And we're not just talking about a collection of popular characters. It's a century's worth of beloved stories, entire universes, from the foundational Mickey Mouse and Cinderella to the incredible sprawling worlds of Star Wars, Marvel, Pixar. This IP is just deeply embedded in global culture. It resonates across generations. And it's rigorously protected by copyright law for, decades.
And here's the key point, I think, and it's critical for investors.
Right.
A competitor can absolutely build a new theme park or launch a new streaming service, but they absolutely cannot replicate Star Wars or Marvel or the emotional resonance of a Disney classic. It's just not possible.
You can't recreate that brand trust, can you? That deep nostalgia, the cultural ritual that Disney has cultivated over generations. Think of a family's first Disney trip. For many, it's like a generational rite of passage, a shared memory that money alone can't really buy. That anchors customer loyalty in a way few other brands can even dream of achieving.
Exactly. It makes their IP not just legally defensible, but emotionally irreplaceable. This vast library of intellectual property is a non-physical asset that is effectively impossible to duplicate. And that gives Disney a unique and crucially sustainable advantage. That's a powerful moat, almost unassailable in that respect. And the most tangible, real-world evidence of this powerful moat is the company's ability to exercise significant pricing power, particularly within experiences. Disney has consistently shown this, uncanny ability to increase prices for its theme parks, its resorts, its cruises, often at rates well above general inflation. And crucially, without seeing a corresponding collapse in demand, people keep coming.
Yeah, you hear the complaints about price, but the parks are still full.
Right. Consider this clear, real-world example. Disney's strategy of price discrimination at Walt Disney World resorts. Between, say, 2018 and 2025, the company actually increased prices for its premium deluxe resorts at a rate faster than inflation. So the real cost to the consumer for those top-tier options actually went up significantly. But conversely, during that same period, the price increases for its value resorts actually lagged inflation, meaning the real cost for those more accessible options went down slightly.
Interesting. So they know exactly who they can charge more.
It's a masterful execution of pricing power. They understand that the unique IP-driven experience they offer creates highly inelastic demand among certain customer segments, people willing to pay a significant premium for that unique magic. Competitors just selling generic rides or hotel rooms simply cannot command the same pricing leverage because they lack that unique intangible asset. The story, the emotional connection, the deeply cultivated brand experience that makes the Disney offering feel irreplaceable to many.
And this pricing power also extends into streaming too, right?
It does. After initially launching Disney Plus at a very low price point, remember that, to rapidly grab subscribers, the company has successfully implemented significant price hikes since then. For instance, in 2023, they introduced a new tiered structure that effectively raised the price of their premium ad-free plan by a substantial 38% if you wanted to keep features like 4K streaming.
Wow, 38%.
Yeah. And this ability to raise prices without seeing, mass subscriber defections is a direct result of the must-have nature of its exclusive content library, which is a key feature of its moat, at least in the streaming world.
Okay. But this raises an important question, though, as we always look to the future. Is this moat widening or narrowing? I mean, its trajectory feels stable, maybe even strengthening in some areas, but it's definitely facing tests, wouldn't you say, as the market evolves?
Absolutely. It's not static. On the widening side, the moat has been substantially strengthened over the past couple of decades through really strategic acquisitions.
Yeah.
Think about the brilliance of buying Pixar in 2006 for $7.4 billion, Marvel in 2009 for $4 billion, Lucasfilm in 2012 for another $4 billion.
Game changers, all of them.
They weren't just buying assets. They were infusions of new, incredibly powerful, multi-generational IP universes. They expanded Disney's appeal to a much broader demographic, sci-fi fans, superhero fans, and provided decades of new content to fuel that corporate flywheel we talked about, significantly extending the life and relevance of the whole brand.
And plus, as management talks about turbocharging investment in experiences, they are actively widening the moat there too, right? By creating more physical, inimitable stuff like Star Wars, Galaxy's Edge, or the upcoming Avatar Land.
Yeah.
Pure play media competitors just cannot replicate those immersive physical worlds.
That's a really key point. That physical manifestation is hard to copy. However, there are undeniable narrowing forces at play as well. The biggest pressure comes from the structural disruption of the traditional media industry. Back in the cable bundle era, Disney's channels, especially ESPN, were absolutely essential, must-haves. This gave the company immense negotiating leverage and these predictable high-margin revenue streams from affiliate fees. That specific part of the moat is, undeniably narrowing as cord-cutting accelerates and the traditional cable model declines.
Yeah, that's a real headwind.
It is, and the new streaming-centric world is just intensely competitive. You've got deep-pocketed rivals like Netflix, Amazon, Apple, all vying for consumer attention and spending. And while Disney Plus has certainly established itself as a major player, its market share in key regions like the US, around 12%, in Canada, maybe 19%, still trails giants like Netflix and Amazon Prime Video. This heightened competition for subscribers, for viewing hours, it represents a formidable long-term test for the moat. If Disney's content were ever to lose its must-have status in this crowded field, its pricing power and profitability would inevitably erode.
So what does this all mean for the Moat's long-term strength? It really feels like a race, doesn't it? Between the highly defensible, maybe widening moat in experiences where they're pouring investment and the more competitive, but hopefully stabilizing direct-to-consumer entertainment moat.
That sums it up well. The good news, I think, is that the experiences segment's enormous cash generation seems more than capable of funding this entire media transition and solidifying Disney's long-term competitive position. It's that enduring physical manifestation of the IP that really makes it unique. It's a powerful anchor in a turbulent media sea.
Okay, let's shift gears a bit. Beyond the balance sheets, the strategic diagrams, the cold, hard numbers.
Yeah.
How do customers and employees truly feel about this company? This feels like a vital piece of the puzzle for understanding its long-term health and, frankly, its long-term investment potential. When we look at customer love, it's kind of a fascinating tale of two very different consumers, isn't it?
It really is. On one hand, you undeniably have the devoted fans. Disney inspires a level of brand loyalty and affection that is incredibly rare in the corporate world, almost cult-like sometimes. The company actually maintains a strong Net Promoter Score, or NPS, of plus 38. Now, for listeners who might not track this, NPS gauges customer satisfaction, willingness to recommend a brand. And with Disney, a high 60% of respondents are promoters, people who'd actively recommend the brand.
That sounds pretty good.
It is good, but in the context of premium brands, especially at Disney's price points, you often hope to see scores pushing 50 or higher. So plus 38 is strong, shows immense brand equity, but maybe also reflects some of the pricing tension we'll get into. This loyalty is incredibly sticky, though. Data shows 83% of customers consider themselves loyal, and that jumps even higher to 89% for those who've been customers for over 10 years.
Wow. And the parks especially seem key to that.
Oh, absolutely. The immersive nature of the theme parks is particularly effective here. They boast a remarkable 70% return rate for first-time visitors.
70%.
Yeah, that's huge. It's a testament to a highly satisfying, magical experience. And this is cultivated through a deliberate focus on creating magical moments, empowering their cast member employees to deliver exceptional service, constantly soliciting feedback. It really sounds like a dream for those who connect deeply with the brand.
Okay, but here's where it gets really interesting, right? Because alongside that deep devotion, that loyalty, a growing chorus of frustration is becoming more audible. And it feels like a crucial signal.
Definitely. There's a significant and growing sentiment that the magic is becoming simply unaffordable for its traditional customer base. An influential 2025 Axios Harris poll actually revealed that Disney's corporate reputation had fallen to a fair rating for the first time ever. That's a sharp decline from its historical excellent tier.
Wow, from excellent to fair.
Yeah. And the poll authors noted that consumer frustration with pricing was a key driver. Apparently, 70% of Americans believe companies are using inflation to boost profits excessively. And this feeling seems particularly acute for Disney, a brand built on accessibility. Another poll found nearly 75% of families now feel a Disney vacation is financially out of reach for them.
3/4 of families. That's striking.
It is. And customer complaints filed with organizations like the Better Business Bureau often echo this. Themes of inflexible policies, a feeling of being fleeced by a company perceived as prioritizing profit over customer hardship. And this isn't just anecdotal. Disney itself has acknowledged a moderation of consumer demand, particularly from lower income households, which suggests that pricing has indeed reached a point of resistance for a significant chunk of their audience. It's a delicate balance they're trying to strike.
This tension feels like a critical strategic risk that any investor has to seriously consider. Disney's cultural power, its long-term brand equity, it was built precisely on its accessibility to the American middle class. Right. If generations start to grow up viewing Disney as an unattainable luxury rather than a cherished, almost guaranteed part of childhood, that deep emotional connection that underpins the whole business model, that magic that drives park visits, merchandise sales, it could slowly but surely erode.
That's the fear. That short-term profit maximization through aggressive pricing could inadvertently impair the long-term brand value, alienating a core demographic that has fueled its success for decades. It's a very fine line to walk, a classic case of balancing immediate financial gains against enduring brand health.
Okay, so what about the folks on the inside? What's it like to work for Disney from their perspective, the cast members who bring the magic to life? For many, living the dream seems like a very real thing. There's immense pride in working there. Just having Disney on your resume is seen as a big career benefit. Frontline cast members in the parks, many corporate employees too, they express a genuine passion for the brand, the joy of creating that magic for guests. Some even describe the culture as familial, saying the company treats its employees better than certain competitors, offering decent benefits, growth opportunities, fostering a sense of community. It sounds like a truly inspiring place for those who really buy into the dream.
However, and there's usually a however, a substantial number of reviews paint a more challenging picture, reflecting that dual nature of Disney, right? Creator of magic, but also a massive publicly traded corporation focused intently on shareholder returns.
Right. The reality check.
Exactly. Common criticisms include compensation that is often cited as below industry average, especially for those front-load roles, long, demanding work hours, and a corporate culture sometimes described as rigid or stuffy. Some former employees talk about a pressure cooker environment where the primary goal is often explicitly stated as satisfying stockholders, sometimes, unfortunately, at the expense of employee well-being or work-life balance.
Yeah, I've heard that phrase, drank the Kool-Aid, used in relation to Disney culture.
Yes, that appears in reviews, suggesting a culture that demands total buy-in, sometimes maybe overlooking the personal cost. And others note that periodic, large-scale layoffs, particularly in corporate divisions, are a regular feature of life there, which can certainly impact morale and foster a sense of insecurity.
And this internal tension, the gap between the dream and the reality for some employees, that could pose a real threat to the premium customer experience we talked about earlier, couldn't it? The premium prices Disney commands are justified, in large part, by that high-quality, immersive service delivered by its people.
Absolutely. If burnout, low morale, or high turnover were to degrade that service quality, if the cast member's smile starts to feel forced, or the attention to detail wavers, it directly undermines the value proposition of their most profitable segment experiences.
Yeah. Ultimately, the magic we all associate with Disney isn't some abstract thing. It's an economic asset. And it's produced and maintained by people. Their well-being, their engagement, their passion. It feels directly tied to the company's long-term success. It's a crucial part of managing the brand of the business. Okay, let's turn our attention now to leadership. How good are the people steering this incredibly complex ship? Is management allocating capital wisely, especially given the opportunities and challenges we've laid out? The current CEO, Bob Iger, he's in his second tenure, right? Having returned in late 2022 after that highly successful 15-year run that saw incredible growth.
Right, he's back with a clear mandate, a significant enterprise-wide transformation, that's the phrase, aiming to restore creative excellence and position the company for renewed growth and profitability.
And his operating philosophy, it seems remarkably consistent across both tenures, which maybe offers some predictability for investors.
I think so. In his first stint, his vision was built on 3 pillars. Generate the best creative content, foster innovation using the latest tech, and expand globally. This philosophy famously guided those transformative acquisitions, Pixar, Marvel, Lucasfilm, which, looking back, were nothing short of brilliant.
Absolutely.
Now, in his return, Iger has outlined 4 new key building opportunities, achieving significant, sustained profitability in streaming, turning ESPN into the preeminent digital sports platform, improving the creative output and economics of the film studios, and importantly, turbocharging growth in that incredibly high-return experiences business.
So a clear focus.
Very clear. Across his leadership, his public statements, shareholder letters, they reveal a mindset focused explicitly on long-term value creation. A relentless pursuit of quality, his mantra is often cited as make it great, and the importance of focusing on a few critical priorities, not spreading resources too thin. He really speaks and acts like a steward, aiming to build renewed strength and drive long-term shareholder value through deliberate strategic action.
Okay, so that's the philosophy. Now, how has he actually deployed the company's considerable cash? The capital allocation track record over the last 5 years or so, especially under Iger, tells a pretty clear story, right? It reveals their strategic priorities.
It does. We can look at capital expenditures, CapEx, the money they reinvest directly into the core business. After being necessarily reduced during the pandemic, CapEx has been steadily increasing. It's projected to reach around $8 billion in fiscal 2025.
$8 billion. That's substantial.
It is, and it reflects a deliberate strategic choice to turbocharge growth in the experiences segment, which, as we discussed, is the company's highest return and most profitable business. So that feels like a very rational allocation of capital towards what's working best.
Okay, what about acquisitions? M&A.
Well, Iger's first tenure was truly defined by masterstroke acquisitions, as we said. Pixar for $7.4 billion, Marvel for $4 billion, Lucasfilm for $4 billion. These deals were supremely rational. They acquired irreplaceable IP that has fueled the entire corporate flywheel and generated returns far, far in excess of their original cost.
Right. But then there's Fox. Then there's the 2019 acquisition of 21st Century Fox for $71.3 billion. That's a much more complex story. The stated rationale was clear: acquire a vast content library, key assets like control of Hulu, to power the company's all-in pivot to streaming. Makes sense on paper. But the sheer size of the deal massively increased the company's debt load, and it was followed by a period of significant stock underperformance, operational challenges, making its value accretive nature highly debatable, at least in the short term. It certainly raised questions about whether it was maybe a case of empire building rather than pure value creation. Fair enough. And finally, shareholder returns, dividends, buybacks.
Right. In a very prudent move, I think, to conserve cash during the unprecedented uncertainty of COVID, Disney wisely suspended its dividend and share buyback programs in 2020. As the business has recovered and cash flow has strengthened significantly, management has wisely reinstated these returns. A dividend was paid in early 2024, with a 50% increase already declared for the next payment in July 2024. And the company also announced a target to repurchase $3 billion of its shares in fiscal 2024, the first buyback since 2018. That's a strong signal of confidence in their current and future cash generation.
So if we apply the rationality test to Iger's capital allocation overall, it seems largely shareholder-friendly, especially given his proven track record. The early IP acquisitions were, without doubt, brilliant. Suspending returns during the pandemic was conservative and, frankly, the correct decision given the circumstances, prioritizing the company's long-term health. And the recent reinstatement of dividends and buybacks is a powerful signal of management's confidence in the company's restored cash-generating power.
Agreed. The primary blemish on this record, as you said, is the price paid for Fox. Strategically defensible, maybe, in terms of content for streaming. But that acquisition has, at least for the last 5 years, been a significant drag on shareholder returns and the balance sheet. But Iger's current strategy appears to be a rational, focused attempt to fully digest this massive deal and restore the company's historical high-margin profitability. It's a complex legacy he's working through.
Okay, but how strong is the company's financial fortress overall? Can it withstand adversity, invest through cycles, or is it on shaky ground? Historically, Disney was a model of consistent profitability, right? A truly reliable earnings machine. Could just print money year after year. However, the last 5 to 10 years, marked by significant volatility, it's safe to say it can't currently be described as that reliable earnings machine it once was.
Well, not right now, no. And this inconsistency was driven by a confluence of 3 major impactful events, really.
Yeah.
The massive debt-financed acquisition of Fox in 2019, the devastating impact of the COVID pandemic in 2020-21, which, of course, completely shut down its highly profitable experiences segment. And then the subsequent period of heavy investment and significant losses required to launch and scale its DTC streaming services.
A perfect storm, almost.
Pretty much. Net income swung dramatically from a profit of over $11 billion in fiscal 2019 to a loss of nearly $2 billion in fiscal 2020 before beginning this slow, arduous recovery. While recent results are encouraging, total segment operating income grew a strong 21% in fiscal 2024. The primary goal of management's current strategy is explicitly to restore that consistent, predictable profitability that was once a hallmark of the company. That's the big picture financially.
Okay, so if we connect this to the bigger picture, a deeper look at key financial ratios over the past 5 years really tells the story of this profound transition, doesn't it?
It really does. Let's start with return on invested capital. ROIC, arguably the most important measure of a company's economic quality. It shows how effectively management generates profits from the total capital it employs, basically, how much bang they get for their buck on every dollar invested.
Right. Crucial metric.
And Disney's ROIC history is the starkest evidence of the challenges it has faced. Before Fox, the company consistently generated excellent double-digit ROIC. For example, a robust 15.6% in 2018. The Fox deal massively increased the invested capital base, lots of non-earning goodwill, physical assets, and the subsequent pandemic and streaming losses crushed the profits. As a result, ROIC just plummeted, hit a low of 1.9% in 2021, and only recovered to 5.2% for the full fiscal year 2024.
Only 5.2%. That's not great compared to historical levels.
It's not, and this is crucial for investors. An ROIC of 5.2% when their estimated cost of capital, what it effectively costs them to raise money, is typically in the 8-9% range. Well, that means every dollar they invest, on average, is theoretically destroying shareholder value if the whole company continues performing at that level. Yeah. This is precisely why Iger's strategy of turbocharging experiences is so critical. He's directing capital to the only part of the business currently generating returns significantly above that cost of capital, aiming to pull the corporate average back up to value-creating levels. A successful investment from today's price is absolutely predicated on this number returning to double digits.
Okay, so ROIC is challenged. What about free cash flow conversion, converting profits to actual cash?
Right. This has actually been a significant bright spot, a source of resilience, often surprising those who just look at the net income line. Even as accounting profits have been depressed, the company's ability to generate cash has remained robust. For fiscal 2024, Disney generated over $8 billion in free cash flow, and management is guiding for roughly $15 billion in cash from operations in fiscal 2025.
$15 billion. That's serious cash.
It is. This strong cash generation provides the fuel for reinvestment, shareholder returns, and it also offers a substantial margin of safety for investors. The divergence between that weaker net income and the strong free cash flow, it's largely due to high non-cash charges, like depreciation and amortization of the massive asset base acquired from Fox, including significant goodwill. These non-cash charges reduce net income on paper, but don't impact the actual cash flowing into the business. It shows that while the accounting picture might look rough due to past deals, the underlying business is still throwing off significant cash.
Got it. And finally, the balance sheet. Debt levels.
Yeah, the Fox acquisition significantly increased the debt load, no question. However, management seems to have maintained a prudent approach to leverage. At the end of fiscal 2024, the net debt to EBITDA ratio stood at a manageable 2.4x. Now, that's higher than historical levels pre-Fox, but it's certainly not in a danger zone, and it's strongly supported by that robust and growing free cash flow, which provides ample capacity to service the debt.
Okay, so summing up the financial picture, the key takeaway, the critical insight here, it feels like it's the divergence between a temporarily impaired return on invested capital and a resiliently strong free cash flow.
Exactly. The investment really hinges on management's ability to close this gap. By growing profits on that massive capital base, thereby driving ROIC back towards the levels of cash return the business is already generating, that's the real challenge and the core opportunity that investors are betting on today.
All right, we've dissected the business quality, the financials, peeled back the layers to understand what makes Disney tick. Now for the million-dollar question. Is the current market price offering an attractive entry point for a long-term owner? Or is the magic maybe already priced in? Let's look at the current valuation ratios, say as of mid-2025. Price to earnings, PE, based on trailing 12-month earnings, Disney's PE is around 25x.
25x. On an absolute basis, for many companies, you'd say that's not exactly a bargain, right? Maybe even a bit expensive.
Yeah, that was my first thought. However, if we shift focus to price to free cash flow, PFCF, also trailing 12 months, that ratio is more in the range of 20.5x to 22.3x. Now that multiple starts to look much more reasonable, doesn't it? Even attractive, maybe, for what is fundamentally a high-quality business with a wide, enduring moat.
Context is absolutely critical here, though. A simple historical comparison of PE can be quite misleading without understanding the underlying business changes the journey Disney's been on. For example, if you just look at the 5-year average PE ratio, it's over 80x. But that number is effectively useless for comparison. Because it was severely distorted by the near-zero, even negative earnings during the pandemic and the peak of their streaming investment, that just wasn't a normal operating environment at all. A much more meaningful comparison is to the pre-2019 period, before the massive Fox acquisition, before the all-in pivot to DTC. During that time, when the company was a more stable, high-quality enterprise, its PE and PFCF ratios typically traded in the 15x to 20x range. So knowing that historical context is vital when assessing today's multiples, we're not quite at those pre-pandemic, pre-Fox multiples, but we're also not in the stratosphere of the pandemic years.
Okay, so what's the crucial judgment here? Based on everything we've discussed, where do we land? We'd say the current price represents
what?
A fair to moderately attractive entry point for a patient, long-term investor. Does that sound right?
I think that captures it well. And here's the reasoning, the core of the investment thesis. You're not buying based on those temporarily depressed trailing earnings or that impaired ROIC of around 5%. Instead, the investment is really a bet on the normalized earning power of the entire enterprise, which we believe is likely significantly higher as this turnaround takes hold.
Right. So the thesis rests on the belief that the competitive moat we discussed is intact, maybe even widening in experiences, and that management is now executing a rational, focused plan to restore profitability across the whole business.
Exactly. If management is successful in growing profits in that powerful experiences segment and achieves sustained profitability in streaming, then the company's ROIC can truly recover from the current 5% level back towards its historical mean of, say, 10% to 15%. As that happens, the earnings in the PE ratio will grow substantially, which would make today's PE of 25x look very cheap in retrospect.
So you're paying a fair price for the current recovering business, but you get this powerful embedded call option almost on the successful restoration of Disney's historical high-return economic profile.
Precisely. And critically, that strong and growing free cash flow provides a solid valuation floor and a really important margin of safety during this transition period. It's a bet on the return to normal, not on some new speculative venture.
Okay. But every investment has potential upsides and, just as importantly, downsides. Let's look at the primary growth engine for Disney's future, and then the permanent risks that could significantly impair the business. The bear case, if you will. The single most important identifiable driver for future earnings growth. It feels like it's the continued deepened monetization of that synergistic flywheel, right? Through a combination of turbocharged experiences segment and a newly profitable streaming business.
That aligns with what we're seeing in management communications, analyst reports. The primary engine will continue to be the growth of that high-margin experiences business. That's the clear priority for capital investment. Specific drivers there. Continued expansion of the Disney Cruise Line, new, larger ships coming online, and the continued strong, resilient demand for theme park vacations, even with higher pricing.
And this reliable, high-return growth will be complemented by the successful maturation of the streaming segment.
That's the plan. Having moved past that initial phase of heavy cash burn just to acquire subscribers, the focus is now squarely on achieving sustained profitability. Via strategic price increases, growing advertising revenue as those ad tiers mature, and disciplined content spending that optimizes for ROI, not just subscriber growth. It's about making those two segments work in concert, feeding each other, to drive the overall business forward.
Okay, that's the bull case for growth. However, while the path appears clear, management has a plan. There are genuine long-term risks that could permanently damage Disney's earning power, not just temporarily slow it down.
Absolutely. And the single greatest risk to the entire enterprise, I would argue, to the very heart of the flywheel, is creative and IP fatigue.
Ooh, yeah. That feels fundamental.
It is. The entire Disney flywheel is fueled by the creation of new, culturally resonant intellectual property. If the creative engines at its core studios, Pixar, Marvel, Lucasfilm, Walt Disney Animation, if they begin to sputter and fail to produce the next generation of beloved characters and stories, the entire business model is threatened. Think about Marvel's recent struggles at the box office. Maybe some Pixar films going straight to Disney+.
Right. Those haven't gone unnoticed.
No. A sustained period of box office disappointments shows that fail to capture the cultural zeitgeist that would starve the high-margin experiences and consumer products segments of the new, fresh content they need to thrive, to draw in new generations, permanently impairing the company's long-term earning power, even that pricing power we discussed. This is arguably the most difficult risk for management to control. Creativity is notoriously unpredictable.
Okay, what else?
Another significant risk is brand alienation and cultural disconnect. As we discussed in the customer sentiment part, there's a tangible risk the brand could damage its relationship with its core multi-generational audience. A combination of aggressive pricing making the experience seem unattainable for the middle class, making it an exclusive luxury, not a universal dream, coupled with perceived stances on divisive socio-political issues. That could deeply erode the brand's unique position as a unifying cultural touchstone for families.
So if it's no longer seen as a rite of passage, but maybe an exclusive, even controversial luxury, its cultural relevance, its moat, could weaken long term.
Exactly. This isn't just about short-term boycotts. It's about a potential generational shift in perception that could be hard to recover from. Finally, there's the pervasive risk of failure to adapt to technological disruption. The media and entertainment landscape is just in constant, dizzying flux.
Always changing.
Always. While Disney made a massive pivot to streaming, it still faces persistent risks from nimbler, more tech-focused competitors. Threats could emerge from new forms of interactive entertainment gaming, the Metaverse maybe, the disruptive potential of generative AI in content creation, experience design, or other unforeseen technological shifts that could render current business models obsolete. The company's own risk disclosures acknowledge this relentless need to constantly adapt. It's a perpetual race, not a one-time fix.
Okay. So to truly understand this investment, we need to go beyond the surface, right?
Okay.
Beyond the obvious narratives dominating headlines. What's the general market consensus when you talk to investors, analysts, and how might a deeper second-level perspective differ?
Well, the current prevailing market narrative surrounding Disney is very much that of a turnaround story under Bob Iger's return to leadership. Wall Street's focus is intensely fixed on near-term data points signaling the progress of this turnaround. Things like quarterly Disney Plus subscriber numbers, the progress of the DTC segment towards profitability, domestic park attendance figures, the immediate box office success or failure of individual movies.
So very focused on the immediate operational execution, the short-term battles.
Precisely. The general consensus seems to be cautiously optimistic. If management can successfully fix streaming and avoid a major slowdown in the parks, the stock is considered a buy.
Okay. But what's fascinating here is that our deeper dive suggests the market might be missing something crucial, maybe overlooking Disney's true unique advantage.
That's our second-level perspective, yes. We think the market underestimates the long-term compounding power and strategic importance of the experiences segment while being overly fixated on the competitive and volatile dynamics of the streaming business.
So the market sees Disney as a media company struggling with the streaming transition.
Largely, yes. Whereas our view is that Disney is actually a unique and irreplaceable global consumer brand whose most profitable and best moated business experiences is now the primary recipient of a massive wave of reinvestment.
And this gives Disney a key, almost unfair advantage over pure-play streaming rivals.
We think so. While the market worries intently about Netflix's quarterly subscriber growth or its content budget, it often overlooks the profound competitive advantage Disney possesses in its ability to translate its IP into the physical world. A competitor can license content, sure, maybe build a huge streaming library, but it cannot build a multi-billion-dollar, high-return theme park land based on Avatar or Star Wars and fill it with millions of adoring, high-spending fans.
Right. That physical world creation is nearly inimitable for a pure streamer.
Exactly. So the long-term value of Disney, therefore, won't be determined by whether it wins the streaming wars in terms of having the most subscribers. Instead, it will be created by operating a profitable, self-funding media engine that serves as a creative wellspring, continuously feeding a multi-decade pipeline of invaluable IP into that incredibly high-return, difficult-to-replicate machine of theme parks, resorts, and cruise lines. That's the real story beneath the surface, we believe.
So the market's focused on the near-term battle, the streaming wars. A long-term investor, though, should be focused on the enduring economics of the entire empire, especially its physical manifestations of magic. That's the real distinction in how you might approach this investment. Well, we've certainly taken a deep dive into the Walt Disney Company today. It's clear this isn't a simple yes or no investment, is it? It's one with incredible, irreplaceable assets, a clear path forward under experienced leadership, but also some very real challenges that need to be navigated. It's a complex and fascinating picture.
It really is. And this raises an important question for you, our listener, to ponder. Weighing that irreplaceable IP, the powerhouse high-return experiences segment, the clear path to streaming profitability. Weighing all that against risks like creative fatigue, brand alienation, technological disruption. What stands out to you as the most compelling point, or perhaps the biggest concern for Disney's future?
Something to chew on, right? If you enjoyed this conversation and found it valuable, if it gave you a fresh perspective, please take a moment to hit that like button. It truly helps us reach more curious minds. And if you want more deep dives like this delivered directly to you every week, definitely hit that subscribe button. We love sharing these insights with you.
Thank you for joining us on this exploration. Until next time, keep digging, keep learning, and keep asking the important questions about the world around you.
Absolutely. We'll be back soon with another deep dive. See you then.